Hey everyone, I'm Vincent Andriaki, VP of Business Development here at ISG Transportation, and I'm back to talk about the North American LTL and full truckload markets for April 2026. As we move through the second quarter of 2026, freight demand has strengthened from seasonally soft levels that we saw in March, with volumes now ramping up as spring activity increases. The persistent surge in diesel prices remains the dominant story. U.S. national averages continue to hover in the $4.80 to $5.30 per gallon range, while Canadian prices are holding between $1.90 to $2.15 Canadian per liter. This ongoing fuel shock, combined with lean carrier operations, is driving aggressive fuel surcharges, taking marginal equipment offline, and compounding delays. Rates continue to see upward pressure with year-over-year increases now ranging anywhere from 18 to 32% in many segments. Plus, additional short-term spikes are tied to fuel. The Canadian trucking market remains more balanced than the US, but surging diesel prices continue to add significant cost pressure and variability. Let's talk demand and capacity. Domestic truckload tender rejection rates have edged up roughly 1% from last month. Tightness is driven by equipment and driver constraints, now further pressured by rising fuel costs and early seasonal volume growth. When it comes to rates, they're modestly higher year over year, with the spot to contract gap narrowing further. Let's talk some key lanes, like Toronto to Montreal, which has steady flows, but there have been some modest fuel-driven rate increases. Calgary to Edmonton has tight capacity and higher surcharges. Vancouver to Toronto has added friction from early produce and forestry moves. And lastly, Edmonton to Toronto, long haul has been impacted by expensive operational costs. If you're shipping in Canada, here's what you should be doing. With diesel prices and spring volumes both climbing, now is the time to lock in dedicated capacity where possible and pair it with a reliable and fair fuel program. Aggressively consolidate shipments to offset your rising per mile costs. Cross-border freight continues to show uneven dynamics, now further amplified by the ongoing diesel surge and the onset of seasonal volume increases. Let's talk demand and capacity. Northbound remains firmer than southbound, with tender rejection rates rising around 1%. Southbound stays softer, with tender rejection rates moving from 3 to 5% to 3 to 6%. But equipment imbalances persist. Rising diesel continues to worsen repositioning challenges in both directions. When it comes to LTL, volumes are relatively steady northbound, but they're softer southbound, and carriers are passing fuel costs a little bit more aggressively. When it comes to full truckloads, northbound flows are more stable, while southbound remains under competitive pressure. Higher diesel is limiting flexibility on these long-haul routes. And lastly, when it comes to rates, they're stable to modestly higher northbound, but southbound shows competitive pricing in spots, with rapid fuel surcharge adjustments pushing all-in costs a little bit higher. Let's talk some key lanes, like southbound Toronto to Chicago corridor has had some delays and equipment shortages. Northbound upstate New York to the greater Montreal area has had stronger consumer good flows than normal, impacting availability. And lastly, Midwest USA to Midwest Canada is experiencing higher volumes due to energy demand. If you're a shipper, here's what you need to know. In this diesel-heavy environment, focus on carriers who can run balanced round trips. Avoid one-way southbound moves when possible, and negotiate fuel surcharge caps on all new cross-border agreements. The U.S. truckload market continues to tighten beyond March levels, which is accelerated by the diesel surge and the ramp-up of produce and construction seasons. Let's talk demand and capacity. National tender rejection rates have moved higher. Dry van from 13% last month to 13 to 15% this month. Reefer, 19 to 21% this month. And flatbed now approaching 25 to 27%. Fuel costs and seasonal volume growth are keeping capacity thin. When it comes to LTL, volumes remain soft but continue to stabilize as some freight shifts toward truckload. When it comes to full truckload, spot rates remain firm with strong year-over-year gains. Diesel surcharges are directly supporting pricing momentum. And lastly, year-over-year increases of 18 to 32% is not uncommon in many segments, with the narrowing spot to contract gap pointing to mid-single to low double-digit increases for 2026 renewals. Let's talk some key lanes, like California outbound has seen strong early season tightness and rate spikes. Florida to New York, Atlanta to Pennsylvania have also seen rising demand, pushing flatbed and reefer rates higher. Houston to Chicago has also seen steady volume and higher operational costs. Laredo to Dallas has been busy due to increased demand for nearshoring. And lastly, Midwest USA has had increased flatbed demand from spring builds. If you're a shipper, here's what you need to know. With produce and construction season now in full swing, shift more freight to LTL or intermodal where feasible, and prioritize limited partnerships. Loadboard US brokers can artificially inflate loadboard demand where freight is broadcasted on a wide network. As we wrap up April 2026, the surging diesel prices across North America remain the defining factor in the freight market. Combined with lean carrier operations on equipment and drivers, this fuel shock continues to compound delays, elevate surcharges, and drive upward pricing pressure as demand firms with the arrival of spring. The market remains uneven and highly sensitive to disruptions, with clear ripple effects on southbound lanes and major corridors. With FMCSA restrictions on non-domiciled CDLs and changes to Canada's temporary foreign worker program, I believe the current tightness may persist longer than many expect. Produce season and construction season are ramping up volumes in key segments, adding further pressure to capacity and keeping rates elevated. Shippers should prepare for some meaningful headwinds in the months ahead. If volumes rise further due to policy adjustments or broader economic stimulus, we can see a more significant market shakeup. For shippers, the priority is simple: build strong carrier relationships that can handle fuel volatility. Incorporate flexible fuel surcharges, consolidate loads, and maintain solid contingency plans. As always, feel free to reach out, as we are always happy to discuss how these developments may affect your operations and come up with strategies specifically designed to better support your business.